The Little Book That Still Beats the Market, by Joel Greenblatt. Introduction. There's a kid I want you to meet. His name is Jason. He's in the 6th grade, and he's quietly building an empire. Every morning on the way to school, he glides by in what you might call his personal limousine, though it looks more like a scooter. He's not wearing designer clothes or fancy sunglasses. In fact, he probably still has a little bit of breakfast on his face. But don't let that fool you. Jason is a businessman. And he is making a fortune. His business is simple. Every day, he buys a few packs of gum. A pack costs him 25 cents and has 5 sticks inside. But once he gets to school, Jason transforms. He becomes a master salesman. He can get his classmates to pay 25 cents for a single stick of that gum. Let's do the math on that. He pays 25 cents for a pack, and he sells it for $1.25. That's $1 of pure profit on every single pack. Selling 4 or 5 packs a day, this 11-year-old is quietly raking it in. Now, imagine you had a chance to partner with him. Imagine Jason comes to you and says, "For a price, I'll give you half of all the profits my gum business makes until I graduate high school." How much would you pay for that? Would you pay $1,000? $500? What about $1? Of course, you'd pay $1. The real price is somewhere in between. And that simple question, what is a business worth, and what is a fair price to pay for it, is the single most important question in investing. It's the question that turns gambling into a science. Today, we're diving into a book that answers this question with such startling simplicity that it feels like a secret whispered from a wise grandfather. It's called The Little Book That Still Beats the Market by Joel Greenblatt. This isn't just another dense book on finance. This is a guide, written by one of Wall Street's most successful investors, so clearly and simply that he originally wrote it for his own children. He wanted to give them a gift that would last a lifetime, a way to make money for themselves. And at the heart of this book is a promise so bold it's almost unbelievable. Greenblatt claims to have a magic formula, a simple step-by-step recipe that anyone can follow to consistently beat the market, outperform the pros, and do it with less risk. Over the 17 years he tested it, his formula turned $11,000 into over $1 million. This sounds too good to be true, doesn't it? If it were that easy, wouldn't everyone be rich? Well, that's the beautiful paradox we're going to unravel. By the end of our time together, you won't just understand the formula. You'll understand the deep, timeless logic behind why it works. And more importantly, you'll understand the one human element that prevents most people from ever benefiting from it, leaving the opportunity wide open for those with the wisdom to see it through. This isn't just about stocks and numbers, it's about psychology, patience, and a fundamentally different way of looking at the world of money. Book summary. So, where do you put your money if you want it to grow? It's the first question every saver has to ask. You could, of course, stick it under your mattress. But that's a losing game. Over time, the prices of everything go up, that's called inflation, and the cash under your bed buys less and less. Your money is silently shrinking. A better option is the bank. You give them your money, they keep it safe, and they pay you a little bit of interest. Let's say you get 5% a year. On $1,000, that's $50. After 5 years, your $1,000 might grow into $1,276. Not bad. It's certainly better than the mattress. Or you could lend your money to the government by buying a government bond. This is considered the safest investment on planet Earth. You give the U.S. government your money for, say, 10 years, and they promise to pay you back with interest. Let's say they pay you 6% a year. This is what we call the risk-free rate. It's the baseline. Any other investment you make has to promise a return better than 6%, because why would you take on any risk if you couldn't? If Jason wants you to invest in his gum business, you need to believe it will earn you more than 6% a year. Otherwise, you just give your money to the government. It's that simple. But let's be honest, lending money to the government is, well, it's boring. There's another option, one that holds the promise of much greater rewards. You can become an owner. You can buy a piece of a business. This is what the stock market is all about. It's not a casino with blinking lights and random numbers. It's a marketplace where you can buy tiny little pieces, called shares, of real, living, breathing businesses. From the company that makes your phone, to the one that brews your coffee, to a nationwide chain of gum stores started by our friend Jason. Let's imagine Jason's business has grown up. He now has a whole chain of stores called Jason's Gum Shops. Last year, the business was a huge success. After paying for the gum, the rent on his stores, his employees, and all the taxes, the business made a profit of $1.2 million. Now, Jason wants to sell a part of his company to the public. To do this, he divides the ownership of his entire business into 1 million equal pieces, or shares. Since the business earned $1.2 million, each one of those million shares is entitled to $1.20 of the profits. Jason decides to sell his shares for $12 each. So here's the question, is this a good deal? You're paying $12 for a share that earned $1.20 last year. To figure that out, we can calculate something called the earnings yield. You just divide the earnings $1.20 by the price $12. In this case, the earnings yield is 10%. Now we have something to compare. The risk-free government bond pays 6%. Jason's business offers a yield of 10%. All things being equal, 10% is obviously better than 6%. But this is where most people get tripped up. Life isn't quite that simple. The $1.20 is what the business earned last year. What will it earn next year? And the year after that? Will a new competitor come along? Will people stop chewing gum? Suddenly, this simple decision seems incredibly complicated. It feels like you need a crystal ball. How can you possibly predict the future? You're competing against thousands of brilliant, hard-working professionals on Wall Street who are trying to figure out the exact same thing. What chance do you have? This is the moment most people throw their hands up in despair. But this is also where Joel Greenblatt gives us our first powerful tool. He introduces us to a character, a famous allegory in the investing world, created by the legendary investor Benjamin Graham. This character is your business partner. His name is Mr. Market. And Mr. Market is not well. He's a manic depressive, prone to wild and unpredictable mood swings. Every single day, he comes to you and offers to either buy your shares of a business or sell you his, and he names a price. The beautiful thing is, you never have to deal with him. You can completely ignore him. Some days, Mr. Market is euphoric. He's incredibly optimistic about the future and offers you a ridiculously high price for your shares, far more than the business is actually worth. On those days, you might consider selling to him. Other days, he's deeply pessimistic. He's convinced the world is ending and offers to sell you his shares at an absurdly low price, far below what the business is worth. On those days, you should take advantage of his despair and buy from him. And on most days, the price he offers is neither a crazy bargain nor a ridiculous premium. On those days, you simply do nothing. This is the stock market. Every day, the news feed is filled with prices, thousands of them, for shares in companies like Apple, or Ford, or Jason's Gum Shops. Last year, shares of a big, well-known company like General Motors might have sold for as low as $30 and as high as $68. Did the value of General Motors really double and then get cut in half in the same year? Of course not. That was just Mr. Market having one of his mood swings. The prices you see on the screen are not the true value of the business. They are simply the price Mr. Market is offering you on that particular day. Your job is not to predict his moods. Your job is to know, roughly, what a business is worth, and then wait patiently for Mr. Market to offer you a silly price. This idea of buying something for far less than it's worth is called investing with a margin of safety. It's your built-in protection against being wrong. If you think a business is worth $10 a share and you buy it at $6, you have a huge cushion. Even if your estimate was a bit optimistic and it's only worth $8, you still come out ahead. This all sounds great in theory. But we're back to the same problem. How do we know what a business is worth? How do we find these bargains without dedicating our entire lives to studying financial statements? This is where Greenblatt reveals his secret. This is the magic formula. He realized that you don't need to be a genius to find great investments. You just need to focus on two, and only two, very simple things. First, you want to buy businesses at a bargain price. We already talked about this with earnings yield. A high earnings yield is better than a low one. It means you're getting more profit for the price you pay. It's like choosing to buy a rental property that generates $30,000 a year in rent over one that only generates $10,000, if both cost the same amount. It's just common sense. You'd rather the business earn more relative to the price you are paying than less. Second, you want to buy a good business. But what makes a business good? Is it the quality of its products? The talent of its managers? Those things are hard to measure. Greenblatt found a simple, powerful number to measure the goodness of a business: return on capital. Don't let the name scare you. The concept is incredibly simple. Return on capital just asks, for every dollar this company invests in its business, building factories, opening stores, buying equipment, how much profit does it generate each year? Let's go back to Jason. Imagine it cost him $400,000 to open one of his gum stores. And last year, that one store made a profit of $200,000. That's a 50% return on capital. That is an absolutely incredible business. Think about it. Where else can you invest money and reliably get a 50% return, year after year? Most businesses can't do that. Now, imagine Jason has a friend named Jimbo. Jimbo owns a chain of stores called Just Broccoli. It also cost Jimbo $400,000 to open a new store. But his broccoli shops only made a profit of $10,000 last year. That's a 2.5% return on capital. So, here's the question. Which business would you rather own? Jason's gum shops with a 50% return on capital, or Jimbo's Just Broccoli with a 2.5% return? The answer is obvious. You want to own a business that earns a high return on its investments. Why is this so important? Because a company with a high return on capital has a special advantage, some kind of secret sauce. Maybe it's a powerful brand name, like Coca-Cola, that allows it to charge more than its competitors. Maybe it's a unique technology, or a brilliant business model. Whatever it is, that special advantage protects its profits from competition. A business like Just Broccoli, with its low returns, has no special advantage. Anyone can open a broccoli store. Competition will always keep its profits low. Even more powerfully, a company that can earn high returns on capital has a magical way of growing. When Jason's Gum Shops makes a profit, what can it do with that money? It could put it in a government bond and earn 6%. Or, it can use that profit to open another gum store, where it can earn 50%. This is how companies compound their earnings at incredible rates. It's a money-making machine that fuels itself. And that is the entire magic formula. That's it. It's a two-step process. 1. Find companies with a high return on capital, the good businesses. 2. Find companies with a high earnings yield, the bargain prices. The formula simply looks for the best combination of those two factors. It systematically finds above-average companies that are trading at below-average prices. It's a disciplined way to take advantage of Mr. Market's mood swings. It finds the wonderful businesses that, for some reason, he has decided to put on sale. So, does this simple, almost childishly obvious idea actually work? Greenblatt went back and tested it. He took all the available data for the largest 3,500 companies trading on the U.S. stock market over a 17-year period. He created a simple system. Each year, He would buy a portfolio of about 30 stocks that ranked highest according to the magic formula, the best combination of high return on capital and high earnings yield. He held them for 1 year, sold them, and then repeated the process with the new list of top-ranked stocks. The results were not just good. They were staggering. Over those 17 years, the overall stock market averaged a return of about 12.3% per year. If you had invested $11,000 in a typical index fund that just tracked the market, it would have grown to about $79,000. That's not bad at all. But the portfolio of magic formula stocks? It returned approximately 30.8% per year. At that rate, the same $11,000 would have turned into well over $1 million. He had more than doubled the market's annual return. And he did it while taking on less risk. When he looked at any 3-year period during those 17 years, the magic formula portfolio never lost money. The regular market, on the other hand, had periods where it lost nearly half its value. Greenblatt tested this on different groups of stocks too. He looked at just the largest 1,000 companies, the big, blue-chip stocks that even giant mutual funds can buy. Even there, the formula almost doubled the market's return. It seemed to work everywhere. He then did something even more revealing. He divided all 2,500 companies into 10 groups, ranked from best to worst by the formula. Group 1 contained the stocks the formula loved the most. Group 10 contained the ones it hated, the terrible businesses at expensive prices. What he found was incredible. The results worked in perfect order. Group 1 performed the best. Group 2 did a little worse. Group 3 did a little worse than that, and so on, all the way down to Group 10, which had terrible returns. The formula wasn't just getting lucky with a few stocks, it seemed to have an almost predictive power about how groups of stocks would perform in the future. This brings us to the most important question of all. It's the question that should be burning in your mind right now. If this formula is so powerful, and now it's published in a book for everyone to see, why would it continue to work? Won't everyone just start using it, causing all the bargains to disappear? And here lies the most profound lesson in the entire book. Here is the secret behind the secret. The reason the magic formula will likely continue to work is that it doesn't always work. In fact, there are long, painful stretches where it fails miserably. On average, in 5 months out of every year, the magic formula portfolio does worse than the market. Sometimes, it underperforms for a full year. Sometimes, it underperforms for 2 years in a row. Greenblatt's study even found periods where it did worse than the market for 3 consecutive years. Now, I want you to honestly imagine yourself in that situation. You've put your hard-earned money into a system you read about in a book. For 2.5 years, you've watched your friends who invested in the popular, hot stocks get rich, while your portfolio has gone nowhere, or even down. Every financial news channel is telling you that your strategy is dead. Your friends and family think you're a fool. Do you have the stomach to stick with it? The vast majority of people do not. The human mind is not wired for that kind of patience and conviction. We are creatures of social proof. We want to do what everyone else is doing, and we want results now. After a year or two of poor performance, most people will abandon the strategy, usually at the worst possible moment, and chase whatever has been working recently. Even professional money managers, who should know better, can't stick with it. Their clients will pull their money out after a few bad years, and they'll lose their jobs. So, to protect themselves, many of them just buy the same popular stocks as everyone else. It's safer to fail conventionally than to succeed unconventionally. And that is the beautiful, ironic reason why the opportunity remains. The short-term unpredictability of the formula is what protects its long-term power. It's the fee you have to be willing to pay for incredible returns. It only works for those who truly believe in the logic behind it, the timeless, unshakable logic of buying good businesses at bargain prices, and have the discipline to see it through, Mr. Market's darkest moods. Success isn't about having a secret formula. It's about having the strength to follow a simple, sensible plan, especially when it's hard. Greenblatt makes it clear that you have a choice. You can try to pick individual stocks on your own. But if you're going to do that, you have to be willing to do the hard work of truly understanding a business and estimating its future earnings. If you can't do that, he says, you have no business buying individual stocks. For those who can, he suggests owning just a handful, 5 to 8, of your very best ideas. But for the other 99% of us, the path is simpler. You can put your money in an index fund, which just tries to match the market's average return. There's no shame in that. Earning the market's average return of around 10% a year over the long run is a fantastic outcome. Or, if you want to do better, you can follow the formula. You can build a portfolio of 20 to 30 of these high-quality, bargain-priced companies. You don't have to understand every detail of every business. You just have to trust that, on average, the simple principles of value will win out over time. In the end, this little book isn't just about a formula. It's a profound lesson in how the world really works. It teaches you to separate price from value, to ignore the noise of the crowd, and to trust in simple, timeless logic. It's an acknowledgement that the greatest challenges in investing aren't financial, they are emotional. And the greatest rewards go to those who can master their own psychology. Commentary. What I find so powerful about Joel Greenblatt's work is that it demystifies a world that seems designed to be intimidating. Wall Street thrives on complexity, on jargon, on the idea that you need to be some kind of super genius to succeed. And this book just gently pulls the curtain back and shows you that at its core, successful investing is based on principles a sixth grader selling gum can understand. The central lesson here isn't a stock picking trick. It's a philosophy. It's the idea of being a business owner, not a stock trader. When you buy a share, you are purchasing a piece of a real company with real assets and real earnings. And your success over the long run will depend entirely on the success of that underlying business and the price you paid for your share of it. That's it. Everything else is just noise. The Mr. Market analogy is, I think, one of the most brilliant teaching tools ever conceived. It perfectly captures the emotional, often irrational nature of the market. And it empowers you. It reframes your relationship with the market from one of fear and confusion to one of opportunity. You are not at the mercy of the market's whims. You are its calm, rational partner, waiting patiently to take advantage of its occasional fits of madness. And the magic formula itself is beautiful in its simplicity. It boils down decades of investing wisdom into two core pillars, quality and price. Buy good things, and buy them for cheap. It's a principle that applies not just to stocks, but to almost anything you buy in life. Yet, in the world of finance, it's somehow revolutionary. The most important takeaway for me, though, is the psychological one. Greenblatt's ultimate point is that knowledge is not enough. The formula is simple to understand, but it is not easy to follow. Its biggest strength, that it works over the long term, is also its biggest challenge, because it requires a level of patience and emotional fortitude that is incredibly rare. So, how can you start applying this wisdom today? Here are a few simple actions. First, change your perspective. The next time you see a stock price flashing on a screen, don't see it as just a number. See it as Mr. Market's offer for a piece of a real business. Ask yourself, is he feeling euphoric today, or is he feeling terrified? This simple mental shift is the first step toward becoming a true investor. Second, embrace a long-term horizon. Greenblatt suggests a minimum of 3 to 5 years. This is not a get-rich-quick scheme. It is a get-rich-patiently plan. Deciding up front that you will not judge your results based on the next quarter or even the next year is liberating. It frees you from the daily anxiety that plagues most market participants. And third, if this approach resonates with you, you can actually see it in action. Greenblatt created a website, magicformulainvesting.com, where he provides a list of the top-ranked stocks based on the formula, for free. You don't even have to invest. Just go look. See what kinds of companies the formula picks. It's a fascinating and practical way to make these concepts feel real. That was the book summary of The Little Book That Still Beats the Market by Joel Greenblatt. We've touched on the big ideas today, the story of Jason, the wisdom of Mr. Market, and the simple power of the magic formula. But a summary, no matter how detailed, is like looking at a photograph of a great meal. You can see what's in it, but you can't taste it. The real magic happens when you sit down with the book yourself. It's in the way Greenblatt's clear, fatherly voice guides you through these concepts, making you feel not just smarter, but wiser. If anything we've talked about today sparked a light in you, I encourage you to grab a copy. Reading it isn't just about learning an investment strategy, it's about building a foundation of financial wisdom that can serve you for the rest of your life. A link to the book is in the description below. Also, if you found this summary valuable and want to continue exploring the ideas in the world's most powerful books, please hit that like button and subscribe to the channel. It tells us we're on the right track, and it ensures you won't miss our next journey into another life-changing book from the billionaire's bookshelf. Let's keep growing together.